Good afternoon, everyone. Welcome to Profit Pulse. If you're just joining us, a warm welcome. Glad to have you here. Today, we're diving into the latest market sentiment, especially with the ongoing US-China tariff developments. Make sure to like this stream, subscribe to the channel, and check out our long videos to understand market psychology and trading strategies in depth. As of now, Wall Street is showing some interesting movements. The Dow Jones, S&P 500, and NASDAQ are all reacting to President Trump's latest statements on US-China trade tensions. Earlier, Trump threatened a 100% tariff on Chinese imports, causing market dips. But recent comments have brought back optimism. Investors need to stay alert because any escalation could trigger volatility. China has responded firmly, calling on the US to withdraw the proposed tariffs and warning of strong countermeasures if the threats continue. This back and forth is creating uncertainty and keeps traders on their toes. Understanding market psychology is key. Investors react not just to news, but also to perception, emotion, and fear. Fear of missing out, loss aversion, and herd mentality all influence market swings. Recognizing these psychological factors helps traders make more rational decisions. If you're finding this useful, don't forget to like, comment, and subscribe. Check out our long-form videos to dive deeper into trading psychology, market strategies, and advanced insights. If you're new here, welcome again. Join the conversation, ask questions in the chat, and engage with our community. Remember, markets aren't just numbers. They reflect human behavior. Stay informed, focus on analysis, and manage emotions to navigate these turbulent times. Thanks for being here, and let's continue exploring the markets together on Profit Pulse. The U.S. markets are buzzing this afternoon as traders continue to digest the latest developments from Washington and Beijing. President Donald Trump's renewed trade rhetoric toward China has become the defining story of the week, and today it's taking a new turn. After last week's shock announcement of potential 100% tariffs on Chinese imports, Trump's tone appeared to soften slightly this morning, hinting that negotiations could be possible if China steps up and plays fair. That slight change in tone has provided a short-term relief rally across Wall Street, with major indices rebounding after a tense few sessions. The S&P 500 and NASDAQ opened higher as traders priced in the idea that Trump's comments might be more of a negotiating tactic than an immediate policy move. The Dow Jones gained early momentum, led by industrials and tech, while Treasury yields held steady, a sign that investors are still cautious but not in full risk-off mode. The market's attention remains squarely focused on how China will respond next. Beijing's Ministry of Commerce issued a brief but firm statement just hours ago, saying China will not be intimidated by tariff threats and that it will take appropriate countermeasures if the U.S. escalates further. Behind the scenes, sources close to diplomatic channels suggest that discussions for a possible Trump-Xi meeting in South Korea are underway, potentially as early as next week. That possibility has been enough to calm traders who were bracing for another round of retaliatory tariffs from Beijing. Remember, this all started after China moved to impose new export controls on rare earth minerals, a move that Trump quickly labeled as a direct attack on U.S. manufacturing and national security. Those rare earth materials are vital for everything from semiconductors to electric vehicles and defense technologies, making this dispute much more than a standard trade spat. The ripple effects are already visible across sectors. Semiconductor giants like NVIDIA, AMD, and Intel are seeing renewed volatility as investors weigh potential supply chain disruptions. Meanwhile, manufacturing names like Caterpillar and Boeing are trading higher today, benefiting from hopes that Trump's America First manufacturing push will translate into more domestic investment incentives. On the other hand, multinational companies heavily reliant on Chinese supply chains, including Apple and Tesla, continue to face uncertainty. Tesla's Shanghai Gigafactory remains a key point of discussion, as analysts warn that new tariffs could pressure costs and margins if tensions worsen. Market sentiment is fragile but not panicked. According to Reuters, hedge funds have started trimming exposure to U.S. equities and reallocating to global industrials, anticipating a longer geopolitical standoff. Still, retail traders are watching closely, especially those active in short-term trades around volatility spikes. Analysts note that even small shifts in tone between Trump and Chinese officials are capable of driving massive intraday swings. The CBOE Volatility Index, or VIX, eased slightly today, but remains elevated compared to last month, reflecting this uncertainty-driven environment. In Washington, lawmakers are divided on Trump's strategy. Some view the tariffs as leverage to force China to play fair on intellectual property and tech transfer issues, while others worry that another trade war could derail an already fragile recovery in global trade. On the economic side, the Federal Reserve is monitoring the situation carefully. Any prolonged trade tensions could influence inflation and supply chain costs, complicating the Fed's decision on future rate cuts. As of now, futures markets are pricing in a roughly 60% chance of one more rate cut by December, depending on how these trade developments evolve. Beyond the politics, there's a growing realization that this US-China tension is no longer just about trade. It's about technology dominance and national security. Trump's latest remarks about restricting Chinese investment in US AI and semiconductor sectors have only added fuel to that perception. Meanwhile, China's push for self-reliance in advanced tech, coupled with new partnerships with Russia and other Asian economies, signals a long-term geopolitical realignment that could reshape global markets for years to come. As for investors, today's message is clear: stay alert and flexible. The US markets are currently reacting positively to the idea of a potential diplomatic meeting, but that optimism could evaporate with a single aggressive statement from either side. Every headline, every tweet, every policy hint is being priced in instantly. Traders are increasingly favoring defensive positions, watching sectors like energy, defense, and domestic infrastructure, which tend to benefit when global trade risks rise. For now, the biggest takeaway is that the market's direction hinges entirely on the next move from Trump and Beijing. Whether it's negotiation or escalation, investors will be responding minute by minute. This story isn't over. It's evolving in real time. And as always, we'll keep tracking every headline, every market reaction, and every shift in sentiment right here for you, live. If you're watching this stream, make sure to stay tuned, because we'll continue breaking down every update as it unfolds. Whether it's the next White House statement, a Chinese countermeasure, or a surprise market rally, we'll cover it all as the US-China story drives the pulse of the global financial markets. Stay with us for more live analysis on how these developments could impact your portfolios, your trades, and the future of the US economy. As the day progresses, the tone across Wall Street remains cautiously optimistic, but the underlying tension is undeniable. Traders are glued to every soundbite from Washington and Beijing, knowing that sentiment can shift on a dime. Around midday, reports began circulating that US trade advisors are in preliminary contact with their Chinese counterparts, possibly laying the groundwork for a diplomatic engagement before the end of this month. While this has not yet been confirmed by the White House, even the speculation has been enough to stabilize market futures and push investor confidence slightly higher. Meanwhile, US media outlets are drawing parallels between today's tariff threats and the 2018-2019 trade war, which triggered widespread volatility and a sharp slowdown in global manufacturing. Economists warn that a repeat of that scenario could weigh heavily on the US consumer sector, just as inflation is showing signs of cooling. However, Trump's supporters argue that his firm stance is necessary to rebuild America's manufacturing base and reduce dependency on Chinese supply chains. "We're finally standing up for our workers," Trump said in a brief press conference earlier today, reiterating his commitment to bring key industries like rare earth refining and chip fabrication back to US soil. On the corporate side, CEOs of major industrial and tech firms are responding cautiously. According to Bloomberg, several large companies are quietly exploring options to diversify production into countries like Mexico, Vietnam, and India, a trend that's been accelerating since the first wave of tariffs years ago. Apple, in particular, is once again in the spotlight, as analysts estimate that up to 30% of its global production could shift out of China within the next 2 years if tensions persist. This realignment of global supply chains could have deep long-term implications, not only for corporations, but for workers, logistics costs, and trade balances worldwide. The stock market's sector rotation patterns reflect these anxieties. Energy and defense stocks continue to attract strong inflows as investors anticipate increased government spending on national security and domestic production. Meanwhile, consumer discretionary and travel sectors are lagging, reflecting concerns that another tariff cycle could raise prices and slow household spending. Gold prices have inched higher, showing that safe haven demand remains alive despite today's equity rebound. The dollar, too, is holding firm against major currencies, supported by strong U.S. Treasury yields and global investors seeking safety amid uncertainty. In the broader geopolitical context, analysts at Goldman Sachs and Morgan Stanley are calling this phase a strategic repositioning rather than an outright trade war. They believe both sides are testing each other's limits before any official policy is enacted. China, for its part, is playing a longer game, carefully balancing retaliation with a desire to maintain economic stability. Recent data from the Chinese Ministry of Commerce shows that exports have already slowed for 3 consecutive months, largely due to existing U.S. restrictions on advanced technology components. If Trump's proposed tariffs were to take effect in November, it could deepen that slowdown, potentially hitting both economies harder than expected. Another major factor today is the investor shift toward AI and semiconductor plays. Despite the ongoing uncertainty, the AI theme remains dominant in U.S. markets. NVIDIA's stock is hovering near record highs, while AMD has surged following reports of a new partnership with OpenAI to develop next-generation computing chips. This optimism in the tech sector is partially offsetting concerns about global trade disruptions. Market strategists note that the AI-driven rally continues to act as a cushion for broader indices, keeping the S&P 500 and Nasdaq from deeper pullbacks even amid political tension. On Capitol Hill, lawmakers are debating how to respond to Trump's aggressive trade stance. Some are urging a more measured approach, warning that a blanket tariff policy could hurt small businesses that rely on imported materials. Others are calling for even stronger action, arguing that the U.S. has been too lenient on China's industrial and technology practices. The political polarization around this issue is feeding into the volatility as investors try to anticipate how much of Trump's rhetoric will actually translate into enforceable policy. The bond market is sending its own signal. Yields on the 10-year Treasury note are holding near 4.2%, suggesting that investors are not yet pricing in a full-blown crisis, but are preparing for potential shocks. Meanwhile, crude oil prices have ticked higher amid speculation that global trade disruptions could affect shipping and logistics. Energy analysts point out that higher tariffs on industrial imports could indirectly push up fuel demand as domestic production scales up to fill supply gaps. As trading continues into the afternoon session, one thing is clear: the Trump-China narrative is not just a headline. It's the heartbeat of the market right now. Every investor, from institutional funds to retail traders, is adapting to a more reactive environment where fundamentals and geopolitics are intertwined. Analysts at Citigroup noted that trading volumes have spiked nearly 15% compared to last week, a clear sign that volatility-driven speculation is back in play. Looking ahead, all eyes are on the potential meeting between Trump and Xi in South Korea. If that summit materializes, it could mark a turning point, either toward de-escalation or deeper confrontation. Until then, markets are likely to remain on edge, oscillating between optimism and anxiety with every statement that comes out of Washington or Beijing. For now, traders are advised to stay cautious, watch technical levels closely, and be ready for sudden reversals. We'll continue monitoring every move, every quote, and every chart as this story evolves. Stay tuned. The next few days could define the direction of the market heading into the final quarter of 2025. This is a live, unfolding moment in financial history, and we'll be here breaking it down in real time, keeping you ahead of the curve, right here on Profit Pulse Live. As we move deeper into the trading day, volatility is tightening again, almost like the calm before the next storm. The market's mood feels cautiously suspended, waiting for the next definitive statement from either side. Reporters at the White House have hinted that Trump's economic advisors are drafting a revised version of the tariff proposal, possibly introducing conditional exemptions for certain strategic imports. That's being read by analysts as a sign of flexibility, perhaps a move to limit damage to U.S. industries that rely on components sourced from China, such as electronics, EV batteries, and industrial machinery. If that revised framework becomes official, it could cool market tensions and open the door for renewed trade dialogue. But let's be clear, this isn't a signal that Trump is backing down. His administration continues to emphasize that these tariffs are part of a national security defense strategy designed to protect American technology and critical materials from foreign control. The broader message is that the U.S. intends to build economic independence from China, even if it means short-term volatility. That long-term decoupling narrative is starting to gain traction among both policymakers and corporate leaders. Meanwhile, investors are watching not only the rhetoric, but also the data. The latest inflation readings came in slightly softer than expected, giving the Federal Reserve a bit more breathing room. Consumer prices rose at an annual rate of 2.8%, down from 3.1% last month, a small but meaningful decline. This has reignited speculation that the Fed might signal another rate cut by December if economic uncertainty grows due to trade friction. That's helping to stabilize sentiment in rate-sensitive sectors like housing and small-cap stocks, even as industrials and materials remain headline-driven. In the currency markets, the U.S. dollar index is holding firm near 105.7, reflecting global investors' trust in U.S. assets despite the ongoing political turbulence. The yuan, on the other hand, has weakened slightly against the dollar as traders factor in potential trade headwinds for China's export-driven economy. That depreciation gives Chinese exporters a bit of relief, but it also signals nervousness about the impact of Trump's proposed tariffs on China's manufacturing base. Across the tech sector, the reaction has been more complex. NVIDIA and AMD continue to show resilience, supported by their exposure to AI and data center growth, which investors see as relatively insulated from tariffs. However, Tesla, Apple, and other companies deeply tied to Chinese supply chains are under closer scrutiny. Apple's upcoming quarterly report, expected later this week, could become a major catalyst, not just for the company, but for the entire market. If Apple confirms any cost pressures linked to trade uncertainty, it could trigger another wave of selling in global tech. Interestingly, Wall Street's institutional tone today is less panicked and more strategic. Hedge funds are rebalancing portfolios, not dumping risk altogether. There's a quiet but significant movement into defense contractors like Lockheed Martin and Northrop Grumman, both seen as long-term winners in an era of heightened geopolitical tension. Commodity investors, too, are repositioning. Copper and aluminum futures have spiked, largely due to fears that Chinese export restrictions could disrupt industrial supply chains, while gold is holding near $2,380 an ounce, a steady hedge against policy shock. Political analysts are calling this a defining moment for Trump's second term. His economic agenda, which once centered on deregulation and tax reform, is now deeply intertwined with global trade strategy. The narrative is shifting from free trade to strategic trade. That change in philosophy has profound implications for global markets, and investors are still trying to price in what that means. Some see it as protectionism, others view it as a necessary restructuring of economic power. Meanwhile, from Beijing's side, the tone remains measured but defiant. Chinese state media released an editorial this morning emphasizing that China will not yield under external pressure, but is open to mutual respect and dialogue. That's diplomatic language, calm but firm. Behind the scenes, sources suggest China might be preparing to announce targeted export incentives to offset any future U.S. tariffs. This would effectively strengthen domestic manufacturers while cushioning their economy from external shocks. Global reaction has been mixed. European markets opened slightly lower earlier today, mirroring Wall Street's initial unease before rebounding as Trump's softer comments circulated. Asian markets, particularly Hong Kong and Seoul, remain volatile, reflecting regional uncertainty over potential ripple effects. Oil markets, too, are reacting, with crude trading near $83 per barrel amid speculation that supply chain disruptions could increase energy costs. All this points to one truth: the world is once again orbiting around the US-China dynamic. It's not just about tariffs, it's about economic dominance, technological sovereignty, and the political theater that connects them. Every corporate earnings report, every economic data release, every international statement is being interpreted through this lens. For traders, that means opportunity, but also risk. Short-term volatility spikes are creating ideal setups for intraday and swing traders, especially in sectors like energy, defense, and metals. But long-term investors are being urged to stay disciplined, focus on fundamentals, and avoid reacting emotionally to every headline. The volatility we're seeing today could just be the beginning of a longer geopolitical cycle, one that may define market behavior through the rest of 2025. As we head toward the market close, we'll keep tracking the tone from both Washington and Beijing. If new statements come in, whether it's an official tariff announcement, a policy adjustment, or a diplomatic meeting confirmation, markets could react instantly. So stay tuned, because this story is developing minute by minute. You're watching Profit Pulse Live, and we'll continue giving you real-time updates, expert insights, and full analysis on how the Trump-China tension is shaping the US stock market, investor sentiment. All right, here's a continuation of the lifestyle script, weaving in the latest real-time news updates as of now. As we push further into the session, the rebound in US equities is gathering traction. Investors appear to be breathing a bit easier following Trump's more conciliatory tone over the weekend. The S&P 500 and NASDAQ have posted solid gains, while the Dow Jones is climbing back after last week's sharp slide. Reuters, a key driver, Trump, over the weekend, posted on Truth Social that the USA wants to help China, not hurt it, softening fears that the 100% tariff threat would be unleashed immediately. Financial Times, meanwhile, U.S. Treasury Secretary Scott Bessent clarified in remarks that the Trump-Xi meeting is still on track and that the 100% tariff does not have to happen. Reuters, those remarks have helped ease jitters in markets, with semiconductor and tech names leading the charge. Broadcom surged nearly 10% after announcing a new chip partnership with OpenAI. NVIDIA also gained, helping to buoy the tech sector and lift the broader indexes. Reuters, however, and this is important, the underlying tensions are far from resolved. China, in recent statements, has pushed back forcefully, urging the U.S. to retract the tariff threat. It warned that if the U.S. proceeds, Beijing will take corresponding measures to safeguard its interests. AP News analysts are sounding caution. Morgan Stanley warns that unless the US-China trade standoff cools, the S&P 500 could be exposed to an 11% pullback from current levels. MarketWatch. Others see the possibility that Trump's aggressive rhetoric is being used as a negotiating tactic, a high-stakes game of brinkmanship. Business Insider. Another dimension to watch, the IMF FLAF World Bank meetings underway this week in Washington are increasingly being viewed as a flashpoint. With finance ministers, central bankers, and global policymakers in town, the Trump-China tariff narrative is expected to dominate the agenda. The risk? Any further escalation could overshadow broader global economic discussions. Reuters, meanwhile, markets globally echo the tension. Asian equities are facing pressure. The Hang Seng Index plunged sharply after the tariff threat, reflecting deep investor fears over economic fallout in China. The Times of India, European markets, however, are showing modest gains on renewed optimism that diplomacy might still prevail. The Guardian. So what should traders and investors keep an eye on in the second half of this session and beyond? Here are the critical monitors: statements from Chinese officials or state media. If China signals a willingness to negotiate, we could see further relief in markets. White House, U.S. Treasury updates. Any reversal or clarification on the 100% tariff threat would be a big inflection point. Earnings season kickoff. Major U.S. banks, J.P. Morgan, Goldman Sachs, are due to report. Their results could tether the broader market's direction. Reuters, global policy meetings. The IMF World Bank meeting could bring surprises, especially if trade tensions bleed into global growth forecasts. Technical levels and volatility. With sentiment fragile, even minor headlines could trigger sharp moves. For now, the narrative is in flux. Markets are tentatively climbing on hope that the tariff threats will be softened, but skepticism remains. The next tweet, speech, or memo could swing sentiment again. You're watching Profit Pulse Live. We'll continue to monitor every twist and turn in this Trump-China saga, how it's rippling through U.S. equities, and what it means for your positions. Stay plugged in. This is where geopolitics and markets collide in real time. Financial Times. And as the story unfolds, traders across Wall Street are now carefully parsing every word from both Washington and Beijing. Futures remain steady for now, but analysts are warning that this calm could be temporary, a fragile pause before the next wave of volatility. According to market strategists at JP Morgan, institutions are quietly shifting their short-term exposure away from Chinese-linked sectors, focusing more on U.S. domestic plays like infrastructure, defense, and energy. That subtle repositioning tells you one thing: the smart money is preparing for turbulence, not stability. Meanwhile, on Capitol Hill, key Republican allies have publicly backed Trump's stance, describing it as necessary leverage to ensure China negotiates fairly. But behind the scenes, some U.S. corporations, especially within tech and automotive, are lobbying for moderation. Executives from Tesla, Apple, and Qualcomm are reportedly seeking direct talks with the administration, concerned that a prolonged tariff fight could disrupt supply chains ahead of the critical holiday quarter. The White House has yet to respond officially, but sources familiar with internal discussions suggest a potential review of the 100% tariff timeline could be announced later this week. Over in Beijing, the reaction remains firm. State-run media outlets have framed the U.S. tariff threats as economic coercion, emphasizing that China will not be bullied into submission. The Chinese Ministry of Commerce reiterated that retaliatory measures are being prepared, though it stopped short of specifying details. Analysts at Nomura believe this is a calculated move. China is holding its response until after the IMF World Bank meetings conclude, allowing it to gauge the global reaction first. Investors are watching how global institutions respond. IMF Managing Director Kristalina Georgieva, speaking earlier today, warned that renewed trade fragmentation could erase nearly 2% of global GDP over the next 5 years if major economies continue down this path. The message was clear. Escalation carries real economic cost, not just political theater. Back in the markets, sector rotation is evident. Semiconductor stocks, which were hit hardest last week, are rebounding sharply today. Nvidia, AMD, and Intel are all trading higher, recovering some of the lost ground as investors interpret Trump's softer weekend remarks as a possible opening for dialogue. On the other hand, industrials and exporters remain subdued. Boeing and Caterpillar are struggling to gain traction amid uncertainty about tariffs on raw materials and machinery. Energy markets are another piece of the puzzle. Oil prices have steadied near $81 per barrel after last week's slide as traders weigh the trade war headlines against solid U.S. demand data. Analysts note that if tariffs trigger slower global growth, it could cap oil demand in the months ahead, but for now, geopolitical risk is keeping prices supported. In the bond market, yields are slipping slightly as investors seek safety. The 10-year Treasury yield is hovering just below 4.4%, reflecting renewed demand for haven assets. The dollar, meanwhile, remains firm. Traders are betting that the U.S. economy is still resilient enough to withstand these trade shocks, especially with unemployment near multi-decade lows. The next 48 hours will be crucial. Any remarks from Trump or Chinese officials could instantly sway sentiment. If the rhetoric turns confrontational again, we could see the Dow give back its recent gains and volatility spike sharply. But if diplomatic signals strengthen, the market could push toward recovery highs by week's end. In essence, this isn't just about tariffs. It's about control, credibility, and timing. Both sides are testing how far they can go without triggering a full-blown financial shock. And for traders, this is where opportunity meets risk. Every candle on the chart, every headline drop, it all matters. This is real-time geopolitics shaping real-time price action. So, as we continue monitoring the flow, stay tuned. The next statement from Washington or Beijing could reset everything you're seeing on your screen right now. Good afternoon, everyone. Welcome to Profit Pulse. If you're just joining us, a warm welcome. Glad to have you here. Today, we're diving into the latest market sentiment, especially with the ongoing US-China tariff developments. Make sure to like this stream, subscribe to the channel, and check out our long videos to understand market psychology and trading strategies in depth. As of now, Wall Street is showing some interesting movements. The Dow Jones, S&P 500, and NASDAQ are all reacting to President Trump's latest statements on US-China trade tensions. Earlier, Trump threatened a 100% tariff on Chinese imports, causing market dips. But recent comments have brought back optimism. Investors need to stay alert because any escalation could trigger volatility. China has responded firmly, calling on the US to withdraw the proposed tariffs and warning of strong countermeasures if the threats continue. This back and forth is creating uncertainty and keeps traders on their toes. Understanding market psychology is key. Investors react as the afternoon session continues. Investors are increasingly focused on the interplay between short-term headlines and long-term strategy. While the immediate reaction to Trump's softened comments has been positive, market participants are acutely aware that any sudden shift in tone could reverse gains in minutes. Analysts at Bank of America note that this dynamic has created a headline-driven market environment, where traditional technical analysis takes a backseat to political and diplomatic developments. Corporate earnings remain a critical factor today. JP Morgan, Goldman Sachs, and Citigroup are reporting within the next 2 days, and investors are watching closely to see if any commentary on trade exposure or supply chain risks emerges. A strong earnings beat could reinforce optimism that US companies can weather geopolitical turbulence, while even minor cautionary notes could trigger broader market jitters. In the tech sector, companies like NVIDIA and AMD continue to benefit from AI-driven growth narratives, which provide a buffer against trade-related uncertainty. Global markets are mirroring this cautious optimism. European equities have shown modest gains as investors interpret Trump's softened rhetoric as an opportunity for de-escalation. Asian markets, however, remain volatile, with the Hang Seng Index and Shanghai Composite experiencing fluctuations tied directly to US-China trade commentary. Currency markets are also reflecting this uncertainty. The yuan has slightly weakened against the dollar, while safe haven flows into the Japanese yen and Swiss franc continue to be noticeable. Commodity markets are reacting as well. Copper, aluminum, and rare earth metals, all critical to technology and industrial production, are experiencing price swings as traders factor in potential supply disruptions. Gold remains elevated, trading around $2,380 an ounce, indicating that market participants are still hedging against geopolitical and policy risks. Oil prices are stable for now, but analysts caution that any prolonged trade escalation could have downstream effects on global energy demand. Meanwhile, policymakers and diplomats are working behind the scenes. Reports suggest that preliminary channels of communication between US and Chinese officials are active, though both sides are carefully controlling public messaging to maintain leverage. The possibility of a Trump-Xi meeting in South Korea remains a key point of interest, as the outcome could significantly influence market direction over the next several weeks. In Washington, there is also a focus on domestic political dynamics. Republican support for Trump's tough stance contrasts with concerns from some Democrats and business lobbies who warn that aggressive tariffs could slow US economic growth and disrupt key supply chains. This internal political tension adds another layer of complexity for investors trying to anticipate the trajectory of US trade policy. For traders, the current environment is characterized by heightened intraday volatility. Short-term movements in stocks, indices, and sectors are increasingly tied to the timing and tone of statements from both Trump and Chinese officials. Technical indicators are still being used, but their predictive power is reduced as sentiment-driven swings dominate price action. Options markets are showing elevated implied volatility, particularly for tech and industrial names that are most exposed to trade developments. Looking ahead, the next 24 to 48 hours will likely be pivotal. Any concrete announcements regarding tariffs, exemptions, or negotiations could trigger sharp market reactions. Investors and traders are advised to monitor not only headlines, but also underlying economic data, corporate commentary, and geopolitical developments, as these will collectively determine market sentiment. For viewers following this live session, the key takeaway is clear. The US-China trade narrative is actively shaping the financial landscape. This is not just about stocks, it's about currency flows, commodities, bond yields, and the global economic outlook. Staying informed, flexible, and disciplined is essential in navigating this high-stakes environment. We will continue providing live updates, breaking down the news, analyzing market reactions, and highlighting the implications for your portfolios. Every statement, tweet, and report matters in real time, and we are here to make sense of it as it happens. As the session progresses toward the late afternoon, traders are increasingly focused on positioning ahead of the weekend, aware that any overnight news from either Washington or Beijing could set the tone for Monday's open. Volume remains elevated, reflecting both institutional and retail participation in this headline-driven environment. Analysts note that sectors most sensitive to US-China trade relations, tech, industrials, and materials, are seeing the largest swings, while defensive sectors like utilities and consumer staples are relatively stable. One particularly important factor is the interplay between tariffs and corporate guidance. Companies that rely heavily on Chinese supply chains are signaling caution in their earnings calls and investor updates. Apple, for example, is reportedly reviewing its manufacturing footprint, exploring alternatives in Vietnam and India to mitigate potential tariff impacts. Tesla, too, is evaluating cost exposure for its Shanghai operations, while semiconductor firms like Intel and TSMC are preparing contingency plans for potential export restrictions. These corporate adjustments, while not yet reflected fully in earnings, are a significant undercurrent shaping market expectations. Global sentiment continues to feed into US market behavior. European indices are showing modest gains, while Asian markets are mixed, reflecting the uncertainty surrounding potential trade escalation or negotiation outcomes. The yuan has weakened slightly against the dollar, signaling cautious investor sentiment toward China's export prospects, whereas the Japanese yen remains strong as a safe haven asset. Commodities remain volatile. Copper and aluminum are sensitive to supply chain news, while gold maintains its position near $2,380 an ounce, and oil is trading around $81 to $82 per barrel, reflecting concerns over global growth and energy demand. Policymakers are also active behind the scenes. While the public messaging remains measured, reports suggest that US and Chinese officials are engaged in preliminary discussions aimed at preventing a sudden escalation. The prospect of a Trump-Xi summit in South Korea remains central to market sentiment. Analysts believe that even hints of successful diplomacy could spark a relief rally, whereas signs of continued rigidity could trigger sharp volatility, particularly in tech and industrial sectors. From a political standpoint, the US domestic scene is adding complexity. While Republicans largely support Trump's tough stance on China, some business lobbies and Democrats are advocating for a more measured approach to avoid harming US economic growth. This division is feeding market uncertainty, as investors try to assess how much of Trump's rhetoric will translate into enforceable policy and what exemptions might be granted to certain industries. The Fed and broader monetary policy context also play a role. Recent inflation data shows modest cooling, giving the Fed some flexibility. Futures markets are pricing in roughly a 60% chance of one more rate cut by December, depending on the evolution of trade tensions and economic data. Bond yields reflect this uncertainty. The 10-year Treasury yield hovers just below 4.4%, indicating ongoing demand for safety. For traders, the environment is both an opportunity and a risk. Volatility is creating potential setups for intraday strategies, particularly in tech, energy, and defense, but long-term investors are cautioned to maintain discipline and focus on fundamentals. The interplay between geopolitics, corporate guidance, and economic data will continue to drive market swings in the near term. As we move into the final hour of trading, all eyes remain on the news cycle. corporate updates, and policy developments. Every statement from Trump or Chinese officials has the potential to reset market sentiment instantly. Investors and traders alike are advised to monitor developments closely, stay agile, and be prepared for rapid shifts in market direction. Profit Pulse Live will continue to track these developments in real time, providing analysis, context, and insights into how the evolving US-China trade narrative is shaping the US stock market and global financial conditions. Stay with us for continuous updates as this story unfolds. Thank you, everyone, for joining today's session on Profit Pulse. I really appreciate your time and engagement. Don't forget to like this stream, subscribe to the channel, and check out our long videos to understand market psychology, trading strategies, and in-depth market insights. Your questions and participation make these discussions valuable, so keep them coming in the chat. Stay informed, stay alert, and remember that understanding market behavior is key to smart trading. Thanks again, and I look forward to seeing you in our next session.